Muy buenos días a todos. Bienvenidos nuevamente a un webinar Vero Norte. Estamos muy contentos de estar con ustedes y empezar una nueva serie de webinars. Antes de empezar, quiero agradecerle a nuestros aliados convocadores. Son organizaciones que se unen invitando a su audiencia a participar en estos webinars. Quiero agradecer especialmente a 10AM Pro, Bancolombia, el Comité Universidad Empresa Estado Sociedad, la Universidad CESA, K50 Ventures, la Vial, nuestros amigos de MacroWise, Ruta N y su programa Medellín Venture Capital, Pontificia Universidad Javeriana en Bogotá, Sapiencia, la Universidad de AFIT en Medellín, la Universidad EIA, Escuela de Ingeniería de Antioquia, Universidad Pontificia Bolivariana y WMI. También quiero dar algunas indicaciones antes de empezar, y es que recordarles que tenemos habilitada la función de subtítulos automáticos en español, gracias a la herramienta en Zoom. Entonces, en la barra inferior, ustedes van a ver un CC, que es el tema de subtítulos, de donde se pueden poner los subtítulos, o captions, es un iconito con una C y una C. Ahí pueden hacer clic, pueden tomar la opción mostrar subtítulos o show captions, y si desean traducirlos en español, hacen clic en una flechita pequeña que hay junto a un icono, eligen el español y ahí pueden oír la conversación o pueden ver los subtítulos en español, si no los pueden ver también en inglés. Esto de todas maneras en el chat general del webinar van a tener esta información. Lo otro que quería decirles es que vamos a estar recibiendo preguntas. Como ustedes saben, tratamos de que sea interactivo. Pongan las preguntas en el chat, en Q&A, y nosotros, Camilo y yo, que vamos a estar moderando la conversación con Chris, estaremos integrando las preguntas en la conversación. Muy bien. Lo otro que quería hacer era hacer una introducción a esta serie. Como les decía, esto es una serie de 3 webinars. El primero con Chris, y es una serie donde nosotros queremos entender desde diferentes perspectivas las inversiones en venture capital, por qué hacerlas, cómo hacerlas, cuál es el rol de este activo en diferentes estilos y portafolios de inversión. Tendremos entonces esta conversación con Chris, donde hablaremos de los fundamentales del venture capital, las mejores prácticas para inversión, los errores comunes y el estado actual de la industria. Después, en septiembre, tendremos una conversación con Sean Warrington, que es el director de inversiones privadas y alternativas de un multifamily office relevante en Estados Unidos que maneja los patrimonios de más de 120 familias. Y finalmente cerraremos la serie con Joanna, que trabaja como directora de inversiones privadas del Endowment de la Universidad de Chicago. Lleva más de 20 años trabajando en el Endowment. Todavía estamos definiendo la fecha, pero será a finales de septiembre o principios de octubre. Con esto entonces voy a pasarme a inglés. I would like to invite now Chris and Camilo to join the webinar. And then we're ready
Buenos
to
días
start.
a todos.
Hey, Chris. Hey, Chris. Chris speaks Spanish because he was telling us that his son-in-law is from Ibagué. Is that right, Chris?
That's right. Un poco. Un poco de español.
Okay, Chris. So, Chris, we are so honored and happy to start this series with you. Thank you very much for joining us today.
Thank you for having me.
Okay, as I was saying in Spanish, Chris, you will help us to better understand the fundamentals of this asset class of venture capital, how to invest in it, and you will give us also a perspective of the current environment in venture capital. Chris, you're a highly respected investor with more than 2 decades of experience investing in venture capital, and your career can provide us a uniquely and complete perspective on how to invest in venture capital, because you started in an endowment in Princeton, and then you move all the way through different areas of investing always in venture capital and alternative assets. Uh, and now you have your own firm where you run a fund of funds. So today you are the founder of Ahoy Capital, this boutique firm. And we will talk all about the different areas of investment, how to do it, and what to do, what not to do. But I would like to start by asking you a little bit more about your journey in venture capital. So could you walk us through the evolution in your career in venture capital, and what were those pivotal experiences that shape your approach as an LP?
It's a great question. By the way, you're kind to say all the nice things you said about me, but I've got to say I would like to sit in on the subsequent seminars because Sean and Joanna are great folks and far smarter than I am. So you're going to learn more from those guys. And I, I'm a sponge for learning. So I'm going to have to get the dates of those and lurk in the back. But in terms of my own journey, I've been really lucky, and I started. Life is a long journey of figuring out the things you don't want to do, right? And when I was in business school, I thought what I wanted to do was be an investment banker at Morgan Stanley, and that's what I did in my summer. And boy, was it a miserable experience. I just had a really, really tough time, and it was the summer of 2000, and things were dead, and from on the deal side, and so I just saw the kind of gratuitous punishment that the managing directors would, kind of mete out to the, just the younger people at the firm just to make them, kind of tough. And I thought that didn't make a lot of sense. And out of that, I had this idea that I wanted to be a principal, not an agent, right? I wanted to be, on the buy side and not the sell side. And so I went back to business school and I bumped into a friend of mine, Seth Alexander, who I'd been in college with. And he was then in the Yale investments office working for David Swensen, the kind of guru, the pater familias of all of endowment management. And I was talking to Seth about how I hated Morgan Stanley, and he said, "Well, you got to, think about endowment management. It's the closest you'll ever come to managing your own multi-billion-dollar fortune. We've got, a single client with low liquidity needs, long time horizon, very few tax headaches, etc. All the great attributes that make endowments great long-term investors." And I said, "Well, hey, could you reintroduce me to Swensen?" I'd taken Swensen's class and actually interviewed for a job at the investments office when I was in college. And he said, "Well, we don't really hire, MBAs because you guys are too broken. We like to hire people right out of college, and you missed your chance." Um, but the guys at Princeton are hiring. And by the way, this is a funny thing. If you indulge me, I'll take 30 seconds to tell you. Seth said, when you go down to Princeton, um, be sure to talk about timber. Timber is this great endowment asset class. It matches the horizon because it's uh, uh, if the price of the commodity is bad, you leave it in the ground, it grows, it has a step. It's a great endowment asset class. It's all counter-cyclical. So I went and had this great interview about timber, and they wanted me to be kind of a real assets guy when I joined. And within 2 weeks, the person who did venture quit. And it was the fall of 2001, which was a miserable time in venture capital, absolutely miserable time. And and they said, who wants to do venture? And I want to say that I, raised my hand, but really nobody else wanted to do venture. So the arrow, kind of pointed at me. Now, what was interesting to me is, I believe in venture as like, kind of the new world's gift to the old world, right? The American poet Walt Whitman writes this poem, and he says, "In California, I see the genius of the modern, the child of the real and the ideal, populous cities and the latest inventions." And he was writing this in the 1850s, right? And I've always thought about that, and I've always loved the idea of creating something where there was nothing to make the world a better place. And we'll talk later about some of the reasons why venture is interesting in a portfolio beyond the kind of warm fuzzies of quote unquote making the world a better place. But I started doing venture and I loved it. And you know what they say? I've been told that con amor y pasión todo es más fácil, right? And so I love venture, and I'll be quick in telling this, but this is actually a big part of my journey and formative to how I think about venture today. Um, the the thing that I struggled with at Princeton was we just had so much money to push around, right? We were trying to put hundreds of millions of dollars into the asset class in a time when the whole asset class was $20 billion, right? It's hard for people to fathom, but um, but venture back then was really still a cottage industry. And so we just had no place to put it, and we had these constraints that we'd put on ourselves. Um, and we couldn't be more than 20% of a fund. We couldn't write a check less than 20 or $25 million dollars. So that kind of set a minimum fund size. And at the time, I was spending, I wanted to be an explorer, like a venture explorer. And I'd studied history in college, and I think about Herodotus, right, the first historian, and really he was what I think a role model for a good investor, because the way he wrote history is he would go from place to place and tell the stories of those places. And so I would come and visit California, and I'd say, "Oh, I'm telling the stories of the startupians, right? Like the people in the land of startups." And so I felt like that primary source, real on the ground insight could really differentiate us. But what I kept hearing over and over and over, and this is again 2001 to 2003 into 2004, what I kept hearing over and over was that entrepreneurial finance was changing, right? Um, Everything that we talk about today in terms of lean startups, so kind of utility computing and kind of offshore development and newer ways to go to market. You could build in response um, to growth instead of in advance of growth. It was all combining to make startups more capital efficient and changing the way startups got funded. And I looked at our portfolio at Princeton that was full of great, fund names, Sequoia, Sutter Hill, Greylock, kind of great folks. And I felt like they were wrong-footed for the environment. They just couldn't write checks small enough to invest in the funds that I thought would matter in the future. And we couldn't at Princeton because we were so large and had to write such big checks. So because of that, I sat down with a guy named David Salem, and he ran a fund called TIF, the Investment Fund for Foundations, and did basically outsourced endowment management for smaller nonprofits. And I was sharing with him my ideas, and he said something that was amazing. He said, I want you to come and join me. I want you to invest without any sense of career risk, because most investors are drawn to the things that are conventional and comfortable. There's this old John Maynard Keynes line. It's better to fail conventionally than to succeed unconventionally in matters of reputation. And there's so many investors who just kind of follow the crowd, and there's no cost to that. But again, I wanted to have this principles mindset, and I said, hey, how can I be different? And David Salem said, look, as an investor, you can be right or wrong, and you don't always have control over that. We're not physicists. We're not building bridges, right? There's no laws of the universe. Sometimes good decisions have bad outcomes. So you'll move along that axis. On this axis, what you control is, are you with the crowd or are you alone? Are you alone? And so many people are so afraid of being wrong and alone that they'll never be right and alone. And so I wanted to be right and alone. He said, "Come join me." And I went and joined TIFF and did a bunch of investing in what became some of the formative microcap VC firms like First Round and Maples, then Floodgate, IA, a whole bunch and it was just a lot of fun. But I didn't have any, kind of specific wisdom. I was just in the right place at the right time because everybody that we backed did well, and everybody that we didn't back did well. And so it was really, kind of a great, time from, kind of 2005 through 2010 and 11. And then I left TIFF in 2011. We had a leadership change. Salem retired. And then I joined a firm called VIA to continue investing in kind of small emerging managers. And I had an opportunity to build funds the way I wanted to build them. So at TIFF, we had a diversified fund that I invested a part of because our clients were small endowments who just wanted private equity exposure, and we provided venture buyouts, growth capital, all in one package. But at VIA, I was able to really craft a fund that could, kind of articulate some of the things that were important to me as an investor. And then when my partner passed away, I lifted those funds out, and that's what created Ahoy Capital. And here we are.
Great. So, Chris, we're going to go back to understand what's going on right now in venture capital, because it seems that we are also in a shifting world, and the whole structure of the industry sometimes is being challenged, and great things are happening, not just in terms of technology, but also in the way venture capital invests. But I want to finalize this section about your journey with a specific question that I wanted to be more related to you and not necessarily to the context or the environment. And is how you have changed as an LP from that early days after the internet bubble, when you came in 2001, 2003 with Princeton, and now, how you have evolved as an LP during all this time?
It's an important question because we're all, as investors, on journeys, right? And I think that our decisions in the past inform decisions we make in the future, right? We're learning machines and entities, right? And when I was at Princeton, we had a real focus on what we called best athletes. So let's just find the best people in a space. And that kind of goes back, and this is actually an insight into how much venture has changed since the beginnings of the institutional era when David Swensen was investing in the mid 1980s. I once said to Swensen, "Hey, how hard was it to start investing in venture?" And he said, it was easy. I go, "What do you mean? It seems like it would be really hard. You were figuring this out." He said, no, there weren't that many firms, and we just defined what we wanted. We met all the firms because there were 20 of them in our target space, and we picked the, half of those firms, the top half, a third we could just discard, and then we picked about 2/3 of the remaining ones, and those we invested in those, and among those were Kleiner Perkins, Sutter Hill, IVP, all these, kind of great firms of the 80s and 90s. And I've often thought about that. And I used to think when I was at Princeton that, we should, kind of boil the ocean and find, the best person who does this or the best person who does that. And you still do, a little bit of that. But the thing that has changed in me most, and this was, a realization during the micro VC era, was if you get the mega idea right, um, you it's a much richer target set. And that's, that I was really inspired by Swensen in that. And so I used to think a lot about best athletes, and now I think about themes, right? So, and you want to find the best athletes within those themes, but it's a much more focused approach. And I used to think that we had to find all the best managers and they all fit a certain template. And the thing I've learned is that there's so many different ways to success, which is why we build portfolios, right? Um, Ross Fabini and the XYZ team do things differently than the True Ventures guys, right? And they do things differently than the first round guys. They all do things very differently, but they all are, kind of consistent with their success. So I used to try to make the world fit my model. And now I kind of realize that the most important thing is for, managers to be authentic to themselves and their kind of path to victory. I don't know if that's a great answer, but those are some of the things I think about.
Now, thank you very much for sharing, Chris. And we will go deeper into portfolio construction and why we build portfolios. But right now, I want to switch gears and establish the foundational framework for our audience. So many of them are very sophisticated financial professionals, but not many of them have specifics, the specific knowledge on the physics of venture capital. So I want to go a step back and try to understand from your point of view, what is venture capital? How do you define this asset class? And one distinguish venture capital from other type of private equity investments or alternative investments? And why does a venture capital fund aim to achieve?
So I think there's a lot of different ways to answer that question, but I think that I used to have behind me my CFA charter. And I'd try to answer it in the most CFA way possible, which is venture capital is typically the longest dated, furthest out of the money option that anybody will buy. And what I mean by that is you're basically investing in volatility. Um, and that takes, a whole bunch of different, forms. And actually one thing I think a lot about is it also varies from geography to geography. And so I would say venture capital, the other thing that defines it is it's probably the only asset class where the expectation is that you will lose money on most of your investments. Um, then the kind of uh a lot of people who answer this question will answer from like a very Silicon Valley point of view about like kind of invention and innovation and kind of creating something where there was nothing. But we've seen venture capital in especially in other geos, like in Asia. One of our managers when I was at TIFF invested in kind of bicycle-based beer delivery. Kind of like Uber Eats or DoorDash for beer, and somebody would come with a backpack of beer and drop it off at your home or your job site or wherever you might need it. And that's not venture capital as I think of venture capital. But it's something that in the fullness of time went to zero, but could have had a very 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 nice return. So ultimately, I think venture is defined by its return profile. Then being more specific, as I think of venture here in Silicon Valley, and as I practice it, is we have two parts of our portfolio. We have an invention portfolio where we work closely with MIT Media Lab. We have a fund there called the E14 Fund. We have a fund at Berkeley that works closely with the CS department and the AI. They run an incubator there with the AI team in the CS department and Microsoft. They're called the House Fund. And so that's where you're creating something where there was nothing. So that's invention as we define it. And then the other part of our portfolio is what I call the innovation portfolio. And innovation is basically applying invention to existing problems. And so we have a lot of that in our portfolio. So right now, a big theme for us is how can you apply AI to make what we call dusty industries, kind of run more efficiently. Um, and so we're doing a lot of that. Um, and that's how I think of venture.
Great. Chris, I just want to dig deeper in what you were saying about this company in Asia. And I will take this example to ask you, what does a company that you back with venture capital look like? In our point of view, it has to have the capacity to grow exponentially, and that could be because it has a new technology and it's tackling a big market. Because if it's not tackling a big market, it's difficult to do it. Or a new business model based on technology that can somehow succeed in an amazing way and become a winner takes all player in the market. What are those characteristics of companies to be able to be backed by venture capital? And then what is the outcome of those companies? You were saying also that you lose a lot of time. So is the power law distribution there? And I want to use this as a way to differentiate our asset class to other private equity asset class when you don't see necessarily those same characteristic on the company, but also the distribution of success is more in a normalized way than in a power law model as we see in venture. Can you elaborate a little bit more on this?
Yeah, so I think that's an important question, and I even look at venture in a very what's the word I'm looking for? Miniature way in a sense because I focus on, seed and early stage. Whereas there are firms, great firms like Andreessen Horowitz or IVP or NEA who will focus as late as pre-IPO companies. But I think the way I think of venture is, um, uh, do you invest pre-spreadsheet or post-spreadsheet, right? And what I mean by that is where, once there are metrics that, when a company has product market fit and traction, and you can model out its unit economics, that's kind of post-spreadsheet. And there are a lot of great investors that do that, like I mentioned, IVP, Summit, a whole bunch of companies, venture companies. But the folks that I focus on are really bringing together something where there was nothing. And I think of venture as the ceiling of the Sistine Chapel in the Vatican, and Adam and God are sitting there with their fingers, kind of oh so close together, and you can feel the electricity of the spark of life going from God to Adam. And I think that's to me what venture is. And so typically the companies that we invest in are a very small founding team, usually a founding engineer, and then sometimes a founding, business person or an engineering team. And what they're doing is they're trying to solve a problem that's not being solved currently today. You mentioned one thing and that I think is very emblematic of this what I call the Sequoia worldview, which is you have to have a big market. I would respectfully push back on that a little bit because what I'd say is a lot of companies that start don't know what the market's going to be. If it's truly a disruptive technology, you have no idea
Mhm.
what the market's going to be. And then uh, the uh, the other thing I'd say is there's some people that are focused on something very specific, and in niche markets, and I always say there's riches in the niches. And so the thing I'd say about that is, we have, for instance, a company. It's a polymer that they developed at Caltech, and this polymer actually has some really interesting uses in terms of lubrication, right? It reduces turbulent flow in pipelines. That's like one application. And if this works the way they think it works, it actually changes radically the economics of transporting fluids, like in oil pipelines over long distances. And there's an incumbent there. These things called drag reducing agents, right? DRAs. And there's an incumbent there, but their polymer shears, so you have to keep injecting it over the pipeline, whereas we don't think this one does. And if this works, if they can get it to work in a pipeline, there's an acquisition the day after for $200 million. And that's not the stuff you read about in the papers. But if it's capitalized right, which we think it is, we can get, 20, 30 times our money in return on that. And that's really exciting. And that's the kind of stuff that we look at. But, it's either a 20, 30 return or nothing. I was just talking to a venture. I had dinner with one of our VCs last night here in Palo Alto, and we talked about an outcome they had, and they felt, sad about it because they said we only returned three times our money. I said you should never be sad, when you return money. He said, yeah, but it feels like a nil-nil tie in soccer, right? Or in football. It's just unfulfilling. What we really play for is those big wins because they drive the portfolio because we've got so many losses.
Great. Thank you, Chris. Chris, and my last question before giving the floor to Camilo is about the conditions outside the company itself that need to be present in order for the company to grow and succeed. The context is also important. What are those specific things that you believe they're needed for a startup backed by venture capital to succeed?
I think a lot about this, and I might be a little biased. In fact, I always think, and one question I want to ask you guys at some point, maybe later in this call is like, what do you believe that you don't think the market believes? And one of the things for me historically has been I believe that there are only one or two places in the world that venture capital, as we think about it, can really thrive. And I met not long ago, they're trying to build a startup ecosystem in London, and I spent some time talking to those guys. And ultimately for me, I you know I worked at before business school. I worked at a strategy consulting firm that was started by Michael Porter, the strategy guru. Um, at Harvard Business School, and he writes a lot about competitive advantage of nations, right? So how what and he has all these examples like why was shoe manufacturing kind of centered in Milan. You can even kind of stretch out, well, like why does Brazil produce so many great soccer players, right? Like there's why did ancient Athens produce so many great playwrights? There's all these there are all these clusters of excellence that happen, and they become magnet. You create these flywheel ecosystems, and so Mike Porter's done a lot of cluster theory work, and that's something I really believe in. And as I thought more and more about it, and I moved out to California, to be in the ecosystem, and then I really understood it. And I think the elements are, you need money, right? There's a lot of great technologies like in the US here we have Research Triangle Park in North Carolina. And there just haven't been great companies that have come out of there, even though there's some great technology, because it's like a capital desert, right? So there's not a lot of money. But that's just table stakes, right? Because money is mobile, right? Like it can move, and nature abhors a vacuum. But even Seattle has struggled, with money. But then you need what I call mentorship, right? Like, and this is something that in which the Bay Area really excels, right? Half the people on my street here in Palo Alto are retired, but all they do is work with startups, and consult to startups and bring a wealth of knowledge about building businesses, and hyperscaling and all that stuff, that is you can't find anywhere in the world. You need momentum, right? Like that's a fragile concept, but people are attracted to things that are moving quickly. And I think that's something that Boston has struggled with, as a U.S. ecosystem. There's just not a lot of energy there. And actually, a friend of mine from college came out. He had started a fintech company in New York, and he came out here to be introduced to a bunch of investors, that I made. I offered him introductions to. And after his whirlwind week on Sand Hill Road, he and I were having dinner. And he said, there's just a belief in energy here. Like energy, there's a manifestation that occurs. And I think that that's part of this momentum. And then the last thing that's really important and really undervalued is entrepreneurial management. And having that, kind of reserve army of people who have built, companies, not the startup people, the people who have an idea, because you can have an idea anywhere, but people who can take a company from 10 to 50 million in revenue, from 50 to 100, 100 to a billion, those, the blitz scalers, right? And there's just a talent, pool of people here in the Bay Area, that exists in few other places. So I'm a little bit of a Bay Area chauvinist, but I think, it's the only place in the world that has, money, momentum, entrepreneurial management, and mentorship, in ways that can support a startup is a very fragile thing. So many things can go wrong, and often do.
Great, Chris. Thank you very much.
Chris, I love that last answer as a segue to this piece I want to talk about, because I feel that Betanorte and you somehow share worldviews, and we feel privileged because we look at U.S. venture capital. That's where we play. So we see the amazing things that entrepreneurs and technology do on a day-to-day basis, but it's not what Colombians or Latin Americans see on their day-to-day. That's not the context that we live in. So when we talk about venture capital, it's sort of a faraway place. It's something that is not necessarily completely understood, and I think it was valuable for Felipe to speak to you about the basics. But now I would love you to give our audience a sense on why should they invest. This is an asset class that's far away. We don't understand it. We don't really know what's going on deep down in biotechnology or in space tech or in artificial intelligence. And I'm a family, I have this portfolio. I've been investing in the public markets for a long time. I may have some alternative funds, some real estate. And now some guys come along and say that this is important. Why should a diversified portfolio, a private portfolio, an endowment, or a family consider having venture capital in their portfolio?
Yep. It's a really important question, and I used to really wrestle with it, and then I had this moment where I realized capital is generally so fluid, right? In the public markets, areas rise, areas fall. In even in private equity, um, there's been a lot of research done that shows that private equity actually doesn't generate alpha, it's just super beta, right? And so from like a philosophical standpoint, I actually think that venture s- the the insight that I had was, and I had this during the CFA exam when I was taking it in 2004. um, there's a whole section about risk premia, right? Like there's no return without risk, right? And David Swenson always said to me, investing is about optimizing discomfort, right? If you're not uncomfortable, you're not taking enough risk and you're not getting compensated, appropriately. And I thought, with money moving around the globe as it does today with such, low friction, all of the risk premia have been arbitraged away, right? Like they're just, it's just so hard to really get, disproportionate compensation. And everything all the compensation you do get ends up actually being super beta, two beta, three multiple beta, right? But I thought about this and I said, wow, venture capital, and again, it goes back to this image in my head I have of kind of God and Adam on the ceiling of the Sistine Chapel with their fingers and the spark. And that was the first 0 to 1 moment, right? And 0 to 1 is actually where true alpha resides, because in that creation of something where there was nothing is the only way that you can actually in the public markets anymore kind of create really discontinuous, value. Now, then there are questions about, kind of portfolio construction. How do you capture that? And are you getting adequately compensated for risks and stuff that kind of, falls off of that? Um, but I think that 0 to 1 alpha is the most important thing. The second most important thing to me is actually if you look at the public markets here in the US, and I don't know if I can speak, globally because I'm just not as familiar, but the markets are getting more and more concentrated in mega caps. And in fact, in the US for a long time, we had a phenomenon where between M&A and buybacks and all kinds of things, the number of publicly listed companies was actually declining. And we had kind of a listing crisis here in the US after the Sarbanes-Oxley stuff in the mid 2000s. So the number of public companies were declining, and this whole like, you know, if you look at Roger Ibbitz's data, the bottom decile of the public markets historically outperforms, right? You get compensated for taking the risk of smaller companies, but those companies that were small kept, kind of creeping up in terms of size because if you go back to the late 90s, there were a lot of companies that emerging growth companies that were going public that aren't going public today. And there's a lot of structural reasons for that. So I think of it as if you want a completeness portfolio, right? If you're just investing in the public markets, you're getting super cap momentum. But if you want exposure to new areas, you mentioned biotech, you mentioned, AI, you mentioned space, new areas where there was nothing that are, kind of really land grabs where there's white space. It's really hard to get that in the public markets. It's only kind of proxy plays to get that real, kind of emerging growth. You've got to go to venture.
Um, I completely agree. I've come to conclude that the decision to not include venture capital in a portfolio is a risky decision.
Mhm.
The complete opposite of adding venture capital, since it's a risky asset, adds risk, given the context of where I can actually capture alpha. Not considering it is not a risk neutral decision. And I love that you compare to public equities, because that is where typically a private portfolio would go look to get exposure to economic dynamism. Just to put a name to that.
I think that's right. And by the way, just to add to that point, I used to guest lecture over at Berkeley and teach the Yale case. There's a Harvard Business School case about the Yale endowment, and I used to ask the kids, what's the lesson of the case? And some kids would raise their hand and say, be equity oriented. Other kids would raise their hand and say, lean into illiquidity, and other kids. And great answers, all of them. But what I would say is actually the lesson of this case is don't try this at home. A lot of people went and copied Yale, but the story of Yale was actually one of good execution. And one thing that's, kind of frustrating, from my seat here in Silicon Valley is I see, particularly, I'm very close to a lot of universities, people fly in from, I always joke and say, because I don't want to name names, but, Bob's College of Knowledge, right? Like wherever, and they fly in for, once, every 6 months, and they don't know what they're investing in. They get, they get their eyes get big and they get excited and they invest, in stuff that, whereas I think really what's important is, like you guys are, ingrained in the ecosystem, right? And it's such a, kind of a good partner for people, because, not to, advertise for you guys, but you really need to have the barriers to entry to venture are actually really high, and having history and relationships, and engagement and that perspective that comes from having, you're like spiders in the web and can feel the vibrations, is really important, because I think the real lesson is don't try this at home.
I want to dig into those two threads, um, around don't try this at home, and then if it's not at home, how should I actually try it? But why not? There's actually a question from the audience that I think is right along these lines. Is where's the risk? Why should I not try this? What happens to the returns? We know they're dispersed. We know that top tier firms, the top quartile captures most of the returns. So what's the catch? We're talking about this as something optimistic. You should have it, but then you're saying, watch out, because this can come and bite you back.
Yeah, yeah. And I think, and Felipe talked about the power law. Venture's actually a really interesting asset class in that, and this is a little bit, mathematical, and I don't have a very mathematical brain, but the pooled mean, if you look at Cambridge Associates, which is a benchmark, the pooled mean, which is basically if you look at all the dollars that went into venture capital and all the dollars that came out, is actually higher. So in a sense, the average venture return is higher than the top quartile return, right? And what that actually means is that the top 10% of firms are actually pulling everything else up. And I even think at the top quartile breakpoint, the 75th percentile firm, you're actually probably not even beating the NASDAQ there, right? And it's, what, and again, we talked earlier about how venture has changed in the time I've been doing it. In 2002, somebody did a survey and found that there were 100 firms investing in venture capital in the United States, in 2002. Today, there are 4,000, right? And I think about that, going back the top quartile. So in 2002, would I have eagerly invested in the 25th best firm? Yes, I would. Today, would I invest in the 500th best firm? Absolutely not. I don't even want to invest in the 50th best firm, right? So having that perspective, and look, I'll tell you, like, I show up at these meetings and we talk about, you know Tim Berners-Lee's vision for Web 3.0. And like, look, I wasn't an engineer, right? I was a history and economics major in college, and people are sitting there, we're talking about stuff that I barely understand, and I live in the ecosystem, but there's so much crap, like just bullshitting in venture, and so many people who show you pretty things, but when you kind of scratch at the surface, it doesn't make a lot of sense. And the other thing that's really important to understand is one of the most painful things about venture is that it's a crowd-oriented business. There are really, 5 or 10% of the people in the business who are true independent thinkers, and then everybody else just wants to follow on. In fact, in every slide deck I get, there's a page about like, look at my co-investors. And the question is, are they inviting, you into their deals, or are you begging to get in? Is one question. And you start to understand that when you're, kind of in person, who's kind of where in the pecking order. And it's sometimes very hard to see from an arm's length.
Completely, and that is not obvious. So we look at averages. Human beings are super happy looking at averages, and in this case, the average does not explain absolutely nothing
Yeah.
about how you should proceed, because most likely you will not get the average, but most likely something far below it.
And by the way,
So
my statistics professor in college said, on average, every human has one testicle and one breast. Right. That tells you everything you need to know about averages.
yeah, um, I also have one that I love. It's not related, but I want to say it is statistically speaking, the world has not ended. Saying that you can't rely on past experience for anything,
Yep. Yep.
or at least past performance. So
Yep.
I want to consider there's again this question in the chat around, I'm in a university endowment or I'm a private portfolio, I'm a family, and I take my investments very, very seriously. And I am convinced that I have to go into venture. I understand the nature of the asset class. I see the returns. I understand the risk. I know the role it plays in my portfolio over the long term. So how should I proceed? What do I need to do? We know there are different avenues, and you and we are funds of funds. There are others. Could you maybe walk us through, the typical options and maybe a little bit of pros and cons, and what would you say is this is the route that will most likely give you a positive experience?
Uh, you know, um, that's an interesting question. What I would look for if I were just starting in venture capital, and I've been really lucky. I've spent my whole career in places that were venture native, right? And it takes a long time. Um, and the routes that we see, people take are either, start with a fund of funds, and some people are happy with a fund of funds because they make one decision, and there's not a lot of administrative complexity. There's one set of, I don't know what the tax regime is, but here in the US, there's, a single K1, one set of capital calls, etc. Um, uh, and so for some people, fund of funds are great long-term solutions. Other people and a lot of our investors kind of use us in this way, is almost as and because they're sophisticated investors, all of our investors are university endowments who want to build their emerging manager bench. And so they'll use us and almost rely on us as an information source. And as we find new managers, we help them get to know the managers. And one thing I'm proud of is that over our lifetime, since 2012, as Ahoy and the predecessor funds, we've put about $400 million into funds as Ahoy, and our investors have come in over the top for about another 300 into those managers, and those managers have in some cases formed long-term relationships with that. And so finding a partner, if you want to go more direct, finding a partner that helps you understand the landscape, and can make introductions is important. And other people, there's a whole venture ecosystem now. I call it the venture industrial complex, where you can show up and go to the Raise conference in the fall here in San Francisco. You can go to, you can follow the Coolwater, cohorts. There's Venture University. There's all these different things where you can try to get to know managers directly. I think all those are, kind of fine. It's just it just feels, like some people love the Raise conference because it's like a curated experience. But I think you have to have a lot of people fly in and then we'll just find three, four managers and invest. I think you really have to, have more on the ground intimacy with the space. And I think fund to funds are, kind of, I'm talking my own book here, but fund to funds are a great way to build that experience base.
I completely agree. And as you mentioned earlier, the space has gotten far more complex than it was a decade and a half ago. So for the investor that is just making its way into the asset class, he'll be hit again by that mean and by a lot more complexity. Making the experience curve and learning how to screen, how to source, how to get access will definitely take a long time. So sounds like the fund of funds is the short way around to maybe having a positive experience.
And the other thing I would add to that is a lot of people love chasing brand names. And when I talk to people who are new to venture, they say, well, I want to get into Sequoia and Kleiner Perkins and Benchmark and all the kind of great firms. And they're not looking for new investors, right? Like we're investors in first round capital, they're raising a new fund, the fund is like multiply oversubscribed from insiders, right? So a lot of people come to Silicon Valley looking to get into brands, and that's a fool's errand. Unless you have some sort of you know particular hook that will help you get in, like a strategic hook. Um, uh, like for instance, I've seen Asian families who run manufacturing entities become strategic partners to some of the, become LPs with a promise of strategic partnerships for portfolio companies. Um, uh, but even that's kind of a hard sell. The other route a lot of people go, and that's why I mentioned the Raise conference, is they want to get into tomorrow's Sequoias or Kleiner Perkins or whatever, and so they try to do the emerging manager route. But emerging managers are really challenging, and I've invested in emerging managers my whole career. Um, and everyone has given me headache. Every single one I've invested in has given me some sort of headache. Whether it's team turnover or things, not going as I expected, or things um, taking longer to come to fruition than I ever, kind of dreamed they would. It's really hard to do it on your own. So I think having a Sherpa is really important.
Um, Completely agree. And just digging a little bit deeper into that. So we just mentioned that probably the 500th best venture fund is not a good idea. Um, Brand names are maxed out. It'll be very difficult to get in if you don't have specific access. And then there's a large cohort of emerging managers that are much more difficult to underwrite. How what would you say around a good strategy? Is it a mix? Trying to do a mix? Is there a world in between that a new LP should be considering? Trying to build a portfolio or a view of where returns could happen for him. How would he balance that out?
What I'd say to that is it varies from person to person and that institution's needs. And one thing I would say, the first thing that comes to mind when I think of new investors and portfolios is venture is a very long dated option. And I have my 2012 fund where we've distributed 2x capital. I have my 2014 fund where I've distributed 1x capital. And there's still a lot of value left in both those funds. But my 2016 fund is distributed zero, right? But we have seed investments in Anduril and Verkada and, you know, Clay and like a bunch of great companies. And our TVPI, actually, I'm really happy with. But our DPI is like, oh my gosh, and that's a 9-year-old fund. And so what some people do is they layer in some later stage, you know, funds that will hopefully have some, you know, kind of some sooner cash flows. Because the dream of venture, you have to be a consistent investor in venture because you can't time, you never know when the great, you know, outcomes are going to come. You have to be disciplined, you know, in your investing. Um, uh, and And the dream is, you know, when you get to kind of 12 to 15 years out, when now your distributions are funding the capital commitments that you're making in year 12, 13, 14, 15. And that's where we were at Princeton, right? We were sending the dollars that we had sent out, you know, in the mid 90s were then coming back with a few of their friends and, you know, and funding our program, and making it cash flow positive, which is, you know, kind of, and you're building value. It was amazing. But that takes a long time to get to.
So just to summarize to see if I understand correctly, your view is venture capital has this nature of return distribution. It's gotten more complex. Technology is now everywhere, and you want to enter. You have to know a lot about yourself, what your objectives are, what is your risk tolerance, how much of a long time frame you can actually take, how much variability you can take among your managers, and then based on that, try to build a portfolio that suits um, that suits those requirements, and ideally be consistent and not try to speculate about which wave, if it was the metaverse or if it's going to be AI, which is the technological wave that is going to provide the actual returns.
I think that's right. And I think the important thing to to think of, I think you've articulated it well. People need to be honest with themselves about what they're looking for. And I will tell you, I know a lot of investors in venture who just want. I remember in the, you know, in the mid 2000s we had someone visit us from the Gulf of, you know, the Persian Gulf, and they wanted to come into venture. And I said, well, what do you want? And they said, well, you know, we want to be able to brag at cocktail parties that we're in Uber and Twitter and everything. And I would say, you know, a unicorn is a company that's valued at more than $1 billion. What's the easiest way to invest in a unicorn? Invest in a unicorn, right? Like it's almost like the old joke. How do you make $1 billion fortune in the wine business? You start with $2 billion, right? Like, you know, so if you just want to be in sexy companies, you can be in sexy companies, right? Like there's a market for that. You know, for us, we want, you know, kind of the most naked optionality. We want to blow up on the launch pad or make it to the moon. But that's not for everybody, right? Other people want to build more balanced portfolios. Now, the role we play in an investor's portfolio is we're a very small part of, you know, Carnegie Mellon or Case Western University or whoever. We're a very small part of their portfolio. They're filling in other parts of the innovation continuum and then the public and private market continuum, but we're a very small piece of that. And I know that's what my role is. We're not trying to build, you know, all things to all people, because that's how I want to spend my time, is making great investments, not marketing and building, you know, huge teams and finding late stage investments. Because I think now this is, you could push back on me, and there are a lot of smart people who are far smarter than me who love late stage investing. And I can acknowledge that late stage investing probably has a good risk adjusted return, but I don't care about risk adjusted, right? I'm just here for the naked, pure octane.
I appreciate that, Chris. I think Felipe has a couple of follow-ups.
Yes, Chris. Chris, I think it's amazing this conversation that you are having with Camilo, because you touch on specific things that we can continue talking about them for a lot of time, especially on strategy, portfolio construction, and you know, self-awareness and understand yourself as an investor in order to make decisions. I want to touch on a specific part of this asset class, if you call it asset class, that is the people. This is a people-driven business.
Yeah.
When a good founder look an investor, it doesn't look for a brand. It looks at a specific guys who knows a lot. You were saying that this capital that you have in Silicon Valley that knows how to grow a company that in this specific stage, in that product, in that market, and those guys are always looking for these people. So there are a lot of personal relationship happening inside that. Also, the GPs, the managers of the funds, they have their character, and these give us a lot of information. I will say even the most important information on how will they invest and behave and help their companies and manage a crisis, etc. How important is that for you as an LP? And how do you do that? How do you try to know the people behind the brands and behind the funds and the firms?
Yeah, it's a very important question, because it's the ultimate people business, right? We don't get to invest in a portfolio. We're investing in people who are then going to go out and make investments on our behalf, and very illiquid investments. So it's even, for people who have hired public market managers, you don't like the manager, you fire them, you get your money back. Sometimes with a gate, it takes a little while, but like in venture, you do a fund, you're on that journey for 10, 12, 15 years sometimes or more. And so you really need to understand the people, and you need to understand. I always say I don't invest in funds. I invest in the behavioral footprint of teams, right? How do each of the partners act? How do they think about risk? How do they think about success? How do they think about, what is their domain expertise? What is what are their networks? How well respected are they? And then how they work with each other, because a lot of the failures in venture capital are teams that kind of fly apart. And in some cases, even those can be successes, but you want people focused on the investing, not the team dynamics. And one thing that's amazing is it's a business that's very backward looking, because the true evaluation horizon is so much longer than than people's attention span. For a long time, Kleiner Perkins, one of the best brands in venture, wasn't successful at all. Right now, they've really turned it around, um, but every time I sit down with people in Silicon Valley, we talk about how, um, uh, this firm or that firm is able to continue to raise money, and then sometimes people whisper, but the managing partner that had a great run in the 90s or whatever, they're spending all their time on their ranch in Montana, or their helicopter in and out estate in Hawaii or whatever, and then they're flying out to the pension funds and wherever, and people think that that person is still hands-on. So understanding that level of engagement, understanding when people are, we always talk about people who are retired on the job. Understanding who's hungry, understanding who's relevant. Once I met with somebody who is really involved in a sector, a very specific sector, and they claim to be very well respected. And I talked to two of the incumbents in that sector, including somebody very senior at the potentially biggest acquirer of these types of companies, and they said that guy's a clown. He's a jerk and an asshole. And while we're not in this business to make friends, or certainly not make friends, but and kind of. The Sequoia guys are, very aggressive guys. They're not people I would invite over to dinner, but boy, are they money makers. But if all the incumbents in a space think that this person is not trustworthy, right? That becomes an issue, right? So to get to the question, how do you determine all this? For us, it's very reference intensive. So every time we meet a new fund, and by the way, generally we're at the point now where we're only spending time with funds that are referred to us by people that we trust, highly, because we build a very concentrated portfolio. Um, we spend a lot of time trying to understand who people are from the people that know them best and have competed with them. And one thing that investors do is they seek confirming data, and we try to avoid that confirmation bias. We actively try to find people who have a different opinion on people's characters. And ultimately that's I think the difference between, kind of success and mediocrity.
Thank you, Chris, for sharing that. I want to switch gears now and try to understand what's going on in venture capital right now. So in the last years, we went through a massive boom, crazy times in 2020, 2021, the frenesy with huge fund sizes. A lot of firms increased their fund size by a lot. The valuations were crazy. There was a lot of people jumping in. You call them tourist investors. And then we saw a massive correction in the market in 2022 and 2023. So you have lived on from your whole experience in many ups and downs of this market. How you describe the state of venture capital right now, and what does it look right now for firms, but also for LPs? And in 2025, are we in a healthier, more disciplined market now? Have we learned from those crazy years of 20 and 21?
It's a great question. The last night at dinner with this fund manager, I had the realization that we always talk about, what are normal times, or what are normal valuations? What's normal? And the American president, Franklin Roosevelt, he came into office, during the depths of the Great Depression, and the first memo he got was titled "Crisis as Routine." And I think about that. I was thinking about that last night. I'm like, well, I've been doing this 25 years. And when I started, venture was in the dumps. And then there was this great run, kind of, from 2004 to 2008. Then there was like a little freeze. And then there was there's never been a normal time in my 25 years. And so it is just crisis as routine. Um, and so, look, here are a couple of things I think about. I just read that a third of all venture dollars this year have gone into 10 companies. 10, right? And venture is starting to look, it's not the, magnificent seven in the public markets, it's the terrific 10 in venture. Funds, 50% of all dollars, I think, from LPs have gone to 10 funds, right? Um, the concentration, venture is always a have and have nots market, but the concentration is even more extreme now. Now, I think some of that is healthy, right? Like, they say the forest has to burn down to create the conditions for the new, kind of trees to grow. And we haven't had a good, kind of burning in a while. There are 60,000 companies that are venture backed. And I think about it, in a good year, you have 1,000 M&A events, 1,200 M&A events. You have 100 IPOs, right? So if you think about the absorption of all these companies, there has to be, a big die off, right? And what's going to cause that? A lot of these companies are going to die of indifference, right? And so I think there's some really interesting dynamics, which is, by the way, why I don't trust anybody's numbers right now. Because, you look at every IPO that's been done, it's been a down IPO relative to the last round, right? You look at people who have portfolios full of companies that ultimately are going to be valued at zero, but yet they're, kind of out there selling. Somebody told me they invested in a fund, as a secondary fund, that had an IRR of 62%. That they were marketing on that IRR of 60%. Everybody's like, wow. And those are their September 30th numbers. And then they, revalued everything for end of year, and that IRR dropped from 62% to 8%. And it's just like, it's, crazy to me. So I've said a lot. What I think, really is going on right now is people have to, kind of return to math, right? Understanding arithmetic. Every dollar demands a return. And so if you're investing today, if you're a fund investing in a company, and you're talking about investing in OpenAI at, $600 million, like, what is your hurdle return on that dollar? Do you want to make 2 times your money? You want to make 3 times your money? You're not going to make 10 times your money, right? unless that's a $6 trillion company, and there's a lot, between here and there. Um, if you're investing in a fund and you're investing in $1 billion fund, you just do the math on that. Like that $1 billion fund, for me to get a return that I begin to think was acceptable, is that fund has to create, $3 billion gross return, which by the way comes back to me after carried interest as a mid twos net, which I believe is the very minimum that you should be getting, um, in venture. So that fund has to generate $3 billion of enterprise value to its ownership in those companies. So Sequoia owned 10% of Google, right? For instance. So if, and by the way, nobody is, there's so many people on these cap tables, nobody's really owning 10% at exit anymore. But they can, and in some cases do, but so in that $1 billion hypothetical fund, boy, you have to actually return, $3 billion, which if you did a great job and own 10%, that means you need to have your fingerprints on $30 billion of enterprise value created somewhere. That's what do you have to believe that? And that's the question I'm constantly asking myself as an LP. What do I need to believe that this person will be, successful? And then putting some math around that. And it's really hard. It's really hard also to believe some of the projections that people are making.
Chris, I want to summarize and not just as necessary summarize, but also to comment on what you are saying, and that something that makes our job, I think, a little bit more difficult. And one is that it's very difficult right now to trust in numbers. And it's not just because of managers are making that up or overvaluating their asset. It's because it's difficult to give real value to what you have in your portfolio. So I always tell investors to avoid just making decisions on those numbers, on past numbers, because first you are looking at the past. Second, you don't really know if those numbers are correct or not. And when you are an LP, you start seeing the same asset being valued in different ways from different managers. I think that the most important thing is what we think at Better North is what are the drivers? What are the character of the people, the process that they are doing, the network they are connected to, the way they invest, what people tell about them in the ecosystem, and if they continue that process or doing the same, they will come up with good results. So it's going even more deeper and further than just numbers. And I think this is an important lesson to learn when you're looking at funds, and those funds that very few of them that come to this latitude and this region to marketing their funds. But the other thing is that there are many funds that have grown crazily big. And then you see it is possible that we can have in the next period of time of investment time for these funds in these vintages that 10 stripes will come out and you will be in 8 of them in order to be able to return what you need to return when you have a multi-billion-dollar fund. And there is also a human nature there, and but the management fees on those funds are huge. So, and those funds were very successful at the beginning, but there were $300 million fund. They were not $1 billion fund.
Yeah.
So how you can see those big funds? What is the role they play in the ecosystem, and what is the way to try to understand how to invest in these times when you cannot trust the numbers?
Yeah. So two thoughts. So the way we think about process, a lot of people start with numbers, right? If you go to if you go to LP school, they say, look at the numbers, right? And I think numbers are a lagging indicator, not a leading indicator. And so the way we look at funds is we try to understand the people, right? Are they, what is their, expertise? What are their networks and relationships? What is their character, right? All that stuff. Then we try to understand the strategy. And I have opinions about strategies, but I'm also not a global expert on everything. I try to have a lot of humility about that. What I want to find are the experts, and I want to understand if there's a resonance between their strategy and who they are. And some people are doing things, it's not always obvious, but some people are doing things that just don't comport with who they are. We invested in a fund in 2001 called Ignition, run by a bunch of really, really smart, accomplished people, technologists from Microsoft. Really like there's Bill Gates and Steve Ballmer. It was basically like the next level of, so like Brad Silverberg and Cam Mervold and like all these really smart people, but they were big company people. And we invested in them at Princeton thinking like, oh, they were going to know something about startups. And they just brought a Microsoft hammer to the nail that is a startup. And it's a very different, kind of, so that's really where that lesson cemented. Out of the people and the strategy falls the portfolio, right? And one thing I like doing is spending time with the portfolio companies, and understanding how the fund found those companies, what edge they had. In investing in the companies, have they been helpful in the growth of those companies, et cetera? And that's really where I spend most of my time beyond after, getting to know the people, but just understanding the portfolio, because that's the people and the strategy in action. And then out of that, in due course, will fall the numbers, right? So I'm actually kind of a numbers nihilist. I don't really believe in them, but you have to look at them. But the other thing I'll say, but so that's how we look at the world. The other way, dovetailing on something that you said, was, you know, there's an investor here that we know really well named Mike Maples, who always says your fund size is your strategy, right? And so when I look at funds that are, growing, their strategy is changing. They can, they often try to like articulate why it's actually the same and they're doing the same, but it's a different strategy. And what people don't often do is re-underwrite those funds for what is essentially kind of a different kind of strategy. So that's kind of that. With respect to the big funds, I don't mean to poo-poo the big funds, because I will say the thing that I've personally been most wrong about is the value of capital as a strategic advantage. I hate it because I feel like companies have weaponized balance sheets, and they've used, kind of capital as a hammer to, kind of bludgeon the competition. But if that's a way to win, that's a way to win. And I look back on, what we call the Web 2.0 era. And if I look back on Web 2, like my big insight there that I got really excited about was lean startup. And wow, it's going to get really cheap to start a company and get it off the ground and then, kind of have success. What I didn't anticipate were the second and third order questions, which are like, oh, wait a second, it's cheaper and quicker to get a company off the ground, but that means there's going to be more competition, right? Barriers to entry came way down. And I didn't appreciate that as much as I should have. And then, what I further didn't appreciate was like actually the big funds played a really important role, because now you could really throw capital at the problem to turbocharge, their adoption or what have you. Um, and maybe the same thing's happening in AI, right? Like AI, there's a lot of ideas, barriers to entry are way down, and maybe the winners are all, kind of go to market wins, right? Not technology wins, right? Like, and Peter Thiel talks about this all the time. He says a good technology with bad go to market will lose every time compared to a medium technology with great go to market. Right. And and maybe capital helps with that. So there's a role for these funds. And again, I think of it in terms of risk adjusted return. I don't think the returns will be as high for $1 billion fund, but they're taking a different kind of risk, which might be less acute. And as long as you're compensated appropriately for that risk, it might make sense. I just don't care to risk adjust, because I don't think you can risk adjust venture capital, because, when you think about risks, it's volatility, and it's in venture, it's like, we had a company where the founder was sleeping with the VP of engineering's wife, and it's just like the guy quit and the company was gone, poof, right? Like the company is like chugging along and like gone, right? Like how do you like put that risk in a modern portfolio theory model? You can't.
Thank you, Chris. Go ahead, Camilo.
Chris, I just want to build on these last comments, and then just propose a last topic, just to be respectful of your time. Is that you've just mentioned that venture has come to a point where there are multiple strategies, and some folks are coming up with new ways to build their portfolio. There's a lot of drivers there. You mentioned one that we also take into account very seriously, which is fund size. And going back to your initial comments on how you've changed as an LP, uh, really go deep into the proposal of a GP, because we are seeing a broad range of ways to do venture. What roles they play different roles in the ecosystem. So there is the chance for returns in a much broader spectrum than we would have seen uh, 20 years ago, where there were these 300 million generalist investors, and now we see a whole bunch of different breeds. And the fund of funds, at least as the way we see it, lets you look at all that, and not be as capital constrained. If you're an individual investor and you can only make one or two tickets, you're probably missing out on a broad range of things that might be going on. So I think I love that comment. Just to finish up,
I think that's really actually an important insight, which is the thing I've really seen, particularly in the last 10 years, is the hyper specialization of startups. You need to have a lot more domain expertise. I think it used to be okay. In fact, there was a study done when I had come into the business showing that the specialist funds captured most of the early wins, but generalist funds captured the big wave as kind of bubbles came and went. And I don't think that's true anymore. I think so. That's why I think you're 100% right. It's important to have a diversified portfolio because you want to put together, a group of specialists that are all jagged pieces that form into a well-rounded circle.
Completely agree. A mix of strategies at the end of the day.
Yep.
I would love you to leave us off with your thoughts on venture now. I know you just discussed the state of venture with Felipe, but I'm put on my hat as a viewer of this conversation, and most of the folks here have most likely not invested in venture. They're considering it, and we've just said that this asset class is going through a transformation. We call it natural selection. Um, and it's happening at the company level, and it's going to happen or continue to happen at the GP level. What gets you excited? Why should I really consider doing venture now? What's going on that this is actually a decision that I need to make?
Yeah. So look, at the end of the day, like everybody's a salesman in this business, right? Everybody's selling something. So I feel like a salesman when I say this, but I've never been as excited about innovation and technology as I am right now. Now, I'm going to break this into two parts, and I'll try to be brief. But like the first part is what I just said. I'm super excited about technology and innovation because I think we're at the beginning of a 30-year boom. I really do believe that. The Whether that's investable or not is a question of whether, that's a more specific question, which is how, around how people, kind of chase those investments and access those investments, and do we see a bubble and all that stuff. But I'm in love with technology, and I think we can find, the people to invest in, this huge technology wave. My optimism about the technology comes. So Tim Berners-Lee was the father of the internet, and he described, four waves of, of the internet. And Web 1.0 was, what we think of as the classic 1990s internet. Web 2 was, what he calls a social web. And now we're in Web 3, which is what he called, actually what he called it was not relevant because I think it's actually a bad name. But the big thing that happens is um, in each of these waves, there are changes in the technology stack. And what I mean by that is the compute layer, the interaction layer, and the data layer. And I could go through how each of those are changing, but just from the interaction layer, which is, I think, the simplest for most people to understand, you think about your computer in 1998, and you were at your desktop on your Yahoo, right? And you were stuck, and the internet was one way; it was just coming to you. Then you think about Web 2, right? And now we have our iPhones and our iPads and our laptops, and we're mobile, right? And we're generating content, and the internet is now working kind of two ways, right? what Berners-Lee said in Web3 and the compute layer that he envisioned was AI, so smart systems, right? And he envisioned a data layer that had identity and security built in, and that's crypto, right? And I hate that Chris Dixon from A16Z appropriated the whole, Web 3.0 into his version of Web 3, and it just means crypto. But really, the Tim Berners-Lee thing talks about AI, crypto, and importantly, the compute layer is now computing is everywhere, right? So the simplest way to describe it is what people talk about with smart cities. But a company that where you can put cameras in old person's nursing homes, and over time, as the person walks down the hall, they can have very subtle, they tip to one side, and that actually suggests kind of something going on neurologically, and you can have an intervention, refer them to a doctor where they can get early help for whatever's going on. And that is driven by, now you have these pervasive sensors, right, out in the world, and the AI to process that and compute it. And then here in the States, we have a lot of laws around privacy and healthcare, but you can, with the crypto, actually use an NFT, which NFTs became silly, but you can use that wrapper to transmit the data in a secure and identity-rich way to the doctor. That's a whole new, pervasive computing application that starts to become really important. Or we have a company that can watch workers on a factory line and see, based, kind of the micro motions in their hands as they're assembling something, to see if they're going to get carpal tunnel syndrome and have to lose time, in work. So this confluence of, kind of compute interaction and data transport starts to become super interesting, and I think is going to really drive incredible value. And can we find people who will invest in it and make money? We hope so.
I couldn't agree more. The fact that compute now can be in almost any situation of life or work or the planets means that we can solve huge problems that are missing markets, and there's a significant value to be derived from that. What I think that the other side of the coin is that that is a much more complex investment environment, and I think it plays on to what we've been discussing, that this is somehow a professional's game, that you have to be very inserted into what's going on and who are the people that are behind this to make smart bets that are not necessarily along the probability distribution curve, but that you have some sort of edge to be able to capture value. So I think Felipe and I are in complete agreement on that. And with this, Chris, we have to say goodbye. You've been extremely generous with your time, with your knowledge and your experience, sharing it with us. I've enjoyed it significantly, and I know that the audience has as well. We've tried to incorporate as much of their questions into our conversation, so I hope we all leave with most of our doubts being solved. And again, thank you. We'd love to have you on September 2nd as part of our audience when we have our next webinar around venture
Please.
capital and family portfolios. Again, thank you, and welcome to join us anytime.
I love it. Thank you. And I'm your humble servant. If anybody has any questions, feel free to reach out to me. If you need a fund of funds, Vero Norte is your play. But I'm glad to answer any questions that anybody has. I saw a question in the chat. Do we invest in LATAM managers? We only invest in US tech hubs. We're our mandate is all domestic. But I love talking to people and sharing the gospel of venture. So thank you for the opportunity to talk to a bunch of smart folks.
Thank you, sir. Have a good rest
Thank
of
you,
your day.
Chris. Thank you. Thanks
Thank
a
you
lot.
all.
Thank you. Bye.